Welcome in now Seth Denson, author of The Cure, a blueprint for solving America's healthcare crisis. Also with us, Dan Geltrude, America's accountant. He's the CPA and founder of Geltrude & Company. Gentlemen, great to see you again.
Hey, John.
Good to be here, John.
All right, Heather is not here today. She is on the road, but she will be back next week. And, you know, there are always ways. There's always a buyer and a seller when things are going kind of crazy like they are right now. But I want to talk about two places, guys, where we see investors really showing a lot of interest. That's in the bond market and the meme stocks we're hearing so much about. Dan, first to you. What do you like better, bonds or meme stocks?
Well, let me start by saying this. I don't like meme stocks. To me, that's all about just gambling. There, to me, is no financial substance behind that. People start chasing these stocks based upon what's going on in Reddit or Twitter. So that is not for me. So by default, even though bond rates are not necessarily great, and with rising inflation, bonds are not exactly where you want to be. Given those two choices, I would go the bond route at this point.
You know, Seth, we've also seen a lot of new interest in these bonds, municipal bonds, other things. And, you know, it's kind of like the meme stocks where you have people online talking about these things, you know, with people like myself who are not, you know, intimately involved with investing. Sometimes you have to read up on these things. It takes some time. You should talk to your own financial advisor, or you can just go on Reddit and hear about how hot, you know, junk-rated municipal bonds are, and you can jump in that if you want to. But we're also seeing this too, not just with municipal bonds, but also with corporate bonds. People are looking for different ways to put their places to put their money.
Yeah, and I'm kind of with Dan. I'm not hot on the bond market just yet, although I think we will get there. But that will depend on raising interest rates. Until that happens, the bond market just really isn't where your money should be, unless you're in a position where you need that fixed asset. But bonds do tend to do better once we do raise interest rates, because for a couple reasons. One, we start to see some global investment. Foreign investors will start pouring their money in. And Treasury bills do better once those interest rates are at a level where there's some return on that. And right now, where bond rates are, specifically in the short-term bond market, they're just not there. So if you're prepping for this, you might want to start thinking ahead. Do what you just mentioned. Talk to your financial advisor. Start looking at things like bond ladders, which are going to mature over time based on what the interest rates do, but set yourself up for success in the future.
You know, I was kind of joking around, Dan, like, you know, everything is so, you know, overcharged right now. It's like your engine's running at 8,000 RPMs. That's the economy. And some people might be looking for something a little bit more vanilla in terms of an investment vehicle, and that's what bonds provide, right?
Yeah, they do. But look, the whole point about we are in an inflationary period, and I believe it's not necessarily transitory, because the policies that are coming out in Washington are causing a lot of this. So unless those policies change, we're going to be dealing with inflation for a while. So people have to think through, how do you stay ahead of the inflation curve, which means you're not sticking your money in the bank with a CD. You're not going with a bond with a fixed rate. You're really forced into the stock market. So for me, if you're already in the market, you probably want to just stay in the positions you are right now if you're happy, and ride through this period of time, whether it's going to be 3 or 6 months or maybe even a year of rising costs.
And when you say, Dan, no policy changes, you're talking about the interest rates increasing. But, you know, Seth, we saw that the projected date for the rise of interest rates move closer to us right now. Do you think they might move it up again if things continue to get worse with inflation?
Yeah, you know, I don't know that they'll move it up. They should. If you want my opinion on it, I think they should. I think looking into 2022, maybe I'm hearing now 2 interest rate hikes. I wouldn't mind seeing a quarter point, half point before the end of the year. I think it's necessary with as much cash as that's in the market and the liquidity that's there. We need to start moving the needle back to a stabilized economy and start hedging against this inflation. And right now, the Fed doesn't seem to want to do that.
Paging Paul Volcker for those interest rate increases. Guys, great to see you. A pleasure to talk to you both, as always, our friends Dan and Seth. And again, Heather will be back with us next week for our Money Huddle. Stay with us.